Hello, I'm David Mandy, President of O&M Partners. I want to welcome everyone today to the town hall call for Cisco Gold Royalties. Cisco Gold Royalties, it trades on the symbols OR on the TSX, and it's also traded under the symbol OR on the New York Stock Exchange. For you that are new to these broadcasts, this event is brought to you by New York-based O&M Partners. We're a marketing and communications company. We are not a broker dealer. We don't accept commissions. We're simply communicators. Since the late 90s, we've been in the business of bringing public companies together with investors in real time. All the information presented is already public. We're hoping this call will give you context, bring information to your attention and help you make a better informed investment decision. Please feel free to chat in your questions through the question pane of the GoToWebinar email, by email, and we'll try to get to all the questions. If not, we'll get back to you right after the call. Before we turn to our host, Sandeep Singh, who's the president of Cisco Gold Royalties, we're going to start with a special presentation by Doug Loud, who's going to give us more of a view from the macro side. Doug's Executive Director of Greystone Asset Management. It's an investment management firm, specializes in exploration production companies. Gold, silver, and copper are their metals. He also does some work in the medical technology space. Doug has extensive experience with options trading, foreign securities, knowledgeable about the law, how it intersects with these small public companies. He's been a wonderful source of information to us over the years, and we're glad to have him here to do the introduction. So I'm going to turn the call over to Doug.
Good afternoon, everybody. This little talk is essentially part two of a two-part talk about gold and other metals. In the first talk, I spoke briefly about various things we look for in the companies we invest in this space. And in this talk, we're going to get a little bit more technical because there are some very specific things one has to watch out for or look for and hope are good. One of the reasons you want to find projects you like, buy them and hold them. There's a joke we have in our office, which is, what's the one thing you have to do today to take the train to New Haven at 3 o'clock? The answer is not what you might think, buy a ticket, etc. The answer is be on the train when it leaves. Why do I say that? Because when these mining companies swoop down and buy one of these little guys, it's like an announcement and bang, that stock is gone. You cannot go, oh, well, they're going to get bought, I'll buy it now. It's already over. You have to have already owned that stock when it gets taken out to be in that game. Another reason, as we were talking about earlier, that the big guys want to buy the little guys, besides the fact that they have to keep their inventory of ounces up, is a wonderful accounting bit of magic. If, for the sake of argument, our junior company's gold is worth, say, $50 an ounce in the ground, so to speak, and they get eaten by the big guy is quite happy to pay them $100 or $200 an ounce in the ground, because the minute the deal is done and that little company's ounces are now part of the big company's ounces, taken into account against the big company's market cap, those ounces are worth $500 an ounce on the books of the mining company, even if they're never going to be mined. And there's a running joke about how there's a lot of moose pasture out there that'll never be mined. You might hear from time to time in the calls that somebody will ask some question about, well, are there any deleterious metals? Sometimes with all gold and copper and silver, you'll also get arsenic. Old copper mines often have a lot of arsenic, which makes it hard for them to sell their product to the smelters. We'll more about that in a bit. When people say that, what they're trying to find out is whether or not there's any bad metals included that are going to cause a problem with the price of the product as it is produced. You're also going to hear mysterious comments about, well, what's happening with the artisanal miners? What's the deal with the First Nations? Artisanal miners are quite common, especially in Africa and like in Burkina Faso and in South America. There are people who live there and they know that there's gold in the soil, so they're out there digging for it themselves. In Burkina Faso, it's fascinating. They drill these little 100-foot deep holes that they climb down into with a rope, bring up some ore, and sell it to another fellow who literally smelts it on site with a little fire and then pays them for it. First Nations are the indigenous population, in this case, ordinarily of Canada. There is a complex legal framework deciding who owns the land and who can work on the land, and you want to just make sure that everything's properly being done with the First Nations. Another thing you want to also hear about is that, for the sake of argument, the firm is doing good things from a societal point of view in the area, that they're building housing, that there's maybe they built a hospital or something like that. There's a running joke that in Minnesota, every single town has a hockey rink that was funded by a local mining company. Another interesting comment you'll hear about is something called closeology. Closeology means our mine is right close to another famous one. That is derived from the fact that there's an old mining expression that says that the best place for a new mine is on top of an old mine. And there is some value to that. If you go to Mexico and look around some of the old mining sites, you'll discover that the Spanish, when they were there 400 years ago, mined what they could see. So if they saw a vein of silver in the side of a hill, you'll see a hill today with a slot cut in it, where they mined all that they could down to the water level because they had no way to go below the level of the water, none of the pumps we have today. But if you mine in that area, you are probably liable to find more metal because they were unable to get it all and or process it all. Today's processing allows them to process a much lower grade ore. Another thing you're going to hear about is the cutoff grade. You got to really watch out for this one. Cutoff grade basically is, well, if we had, for the sake of argument, an open pit mine, we would mine it down to where the ore reaches a certain grade, say 2% copper or 2% gold. That's all well and good, but then when the price of gold goes up, they can decide, oh well, we can lower our cutoff grade to maybe 1.5, and voila! The minute they do that, they now have vastly more ounces to produce than they had before, or so they say, and it sounds great. And they don't then cut it back when the price of gold goes down again. So that's one of the things we have to keep an eye on. Another thing, I find this one astonishing, is known as true width. You'll see all sorts of reports, which are written in real legalese because they don't want to say anything good. But basically they'll say that, oh, well, they found, on their drilling, they found a stretch of material that is 5% gold and 15 meters wide. Well, that's great if it's really 15 meters wide. And why do I say that? Well, the veins are on a slant. And when the drill hits them, did it hit them at a perpendicular angle so it's really going across that vein? Or did it hit it kind of on a slant so it's going diagonally down the vein? And in reality, what was really only a 3 meter wide vein is now appears to be a 20 meter wide vein because they went down the vein. Unfortunately, you do have to pay attention. It's up and running. It is going to produce material. Ordinarily, the material that a gold or silver mine produces comes out either as what's known as concentrate or doré bars. Concentrate is, if you will, ground up material that's been treated ordinarily with a lot of chemicals. It then gets to a certain percentage of metal, goes literally in big sacks that are carted away and shipped off to a smelter where they are then processed. And the mining company is then paid at a later date for the material that the smelter managed to process. There's a very complicated formula on how they do that, so we won't go into that here. One of the things about concentrate, though, is that basically the miner ships his material off to the smelter processes it and pays him, as I said. But there have been instances where during the processing period, the foreign exchange rates went one way and the mining metals prices went another way, and people got a bill, in one case that I'm aware of, for $19 million instead of a big check for $19 million. Another thing that has much less risk from my point of view is doré bars. That's where, because of the kind of material that's being processed, they can literally process it, melt it down, and pour it into molds that look like sort of big loaves of bread and weigh about 85 pounds, called doré bars, that are maybe 90% gold and 10% silver. And then those bars are shipped off to be sold, period, end of story. But another thing to keep an eye on, and why you want to pay attention, is it a gold and silver mine or a gold and copper mine or whatever, is that you announce, in effect, that you are a gold mine. If you find a lot of copper, All the money you get from the copper is then used as a credit against your costs. So for the sake of argument, you could have an $800 an ounce for gold actual cost, but then when you take into effect the revenues you're getting from the copper, surprise, your cost just went to $600. Another thing to keep an eye on. They're making a lot of money on both sides of it, but the way those calculations are done can be a little confusing. I would stop to say briefly, however, that it's wonderful to find a gold and copper mine because the copper companies have lots of money and can afford to swoop in, like I was talking about earlier, where the big guys eat the little guys because they have the money to do that. Sort of coming to the end of today's sermon on that. It's been great talking to you. I hope I've been helpful. If you have any questions, please let me know. Thanks a lot.
Thank you, Douglas. Appreciate you doing for the introduction. And now we're going to turn to our host, Sandeep Singh. Sandeep joined Osisko Gold Royalties in this past January. He has a bachelor's in mechanical engineering from Concordia University, and he has an MBA from Oxford University. He's 15 years prior to his new position, he was an investment banker in metals and mining, worked with Dundee, BMO, also most recently Maxit Capital. He's the co-founder of Maxit, which was instrumental in building this independent successful advisory firm, which acted on some of the more complex and value-enhancing transactions in the mining sector. So it's a real pleasure to turn the call over to Sandeep.
Great, thank you, David, and hello, everyone. Sorry, let me just get set up here. Hopefully you are looking at a screen right now. If not, Scott.
Yes, we are.
Okay, perfect. So
you look great, Sandeep. Everything looks good.
Great. Thanks, everyone. So look, as you heard, I recently joined as president of Osisko Gold Royalties after a 15-year career in mining investment banking. Also on the line is Sean Roosen, our chairman and CEO. I'll run through the presentation. Hopefully, if we get things right, he'll be on the line for the Q&A portion as well. So I guess what I would say is, just to follow up on that, new to my role as president of Osisko, but certainly not new to the company. In those 15 years of mining investment banking, Osisko and its predecessors and its sister companies have always been core clients of mine. So back in 2008, 9, 10, I helped finance the build of Canadian Malartic in Osisko 1. Helped the group on its hostile defense from Goldcorp in 2014, which is how Osisko Gold Royalties came to be with the 5% NSR on Canadian Malartic, and I've been involved in most of the transactions that have actually led to assets being within Osisko Gold Royalties since then. So new to my role, not new to the company, and joined Sean and team, a group of people that I know intimately well, a group of assets that I know intimately well, this year to kind of help revamp the management team and move forward on the next phases of growth. I guess before we get into the presentation, we certainly need to touch on the last 2 weeks of in terms of what's been going on in the world and the market. It's been a pretty shocking time for everyone, and it should give you, I think, our perspectives on what it means for the gold sector and what it means for us at Osisko. First and foremost, if you're spending this hour with us, I hope everyone is healthy and safe and staying that way. You know, that's priority one. We at Osisko Royalties have certainly taken things seriously. Our whole office has been working remotely for almost 2 weeks now, which is easier said. It's easier done for us. You know, we are a corporate office, a relatively small office. Everyone can work from home with a laptop and a cell phone, although I will say, you know, has its drawbacks. I scrambled around the house today to look for some tech, which is why I've got these rather large headphones on. But other than that, we're doing fine. It's harder, obviously, for our operating partners, the folks that run our mines, but we commend them on the job they're doing with the plans they put into action over the last week and longer on doing whatever they can as citizens to flatten the curve and also to protect the health and safety of their employees and the communities they operate in. So we certainly understand that. We kind of expected many of our mines or some of our mines to have temporary shutdowns, which they're currently in the midst of. You can't have a situation where the entire world is shut down, but for some reason gold mining gets a free pass. So I think it's just natural. That's from a social perspective. From a business perspective, though, before we get into things, what does that mean for us having some of our assets on care and maintenance for whatever the case may be, 2 or 3 weeks? Just yesterday, the Quebec government decreed that mines in the province be put on care and maintenance till 13th of April. So that's in the process of one of our significant assets being Malartic. From a business standpoint, really, it's just a deferral of revenue for us. We don't have the same fixed cost structure as the operators do. We don't need to carry the cost of having those assets be on care and maintenance. So really, it's a very short-term deferral of that revenue. And frankly, when those mines come back into production, I certainly see a high probability that the gold price that we'll be benefiting from at that point in time can in fact be a lot higher than we would otherwise in these next couple of weeks. So that's what it means in terms of the disruption to our business, relatively minor, and hopefully we can get back to a situation where those mines are producing. I think it's fair to say that it's been shocking to see the world kind of grind to a halt as it has in the last 2 weeks for obvious reasons. Be interesting to see how we come out of that. You know, it's not a small challenge to have the economies of the world kind of restart themselves in what from this kind of unprecedented stop, certainly from my knowledge base. I think it's fair to say, though, restarting a mine is pretty straightforward. It's technology, it's people, it's brute force. Restarting economies and in a world where people's behavior, I think, certainly is changed and it's going to continue to change. Be it travel, when and if they travel, how they work, mental health, medical care, all those types of things. Those are going to change for the foreseeable future, and eventually everything reverts back to a mean. But I think it'll be certainly changes in the near and medium term. What hasn't changed, though, is how governments deal with these external shocks, and the way they deal with them is to print money. So this, now, this time around, it's coronavirus that led to this downturn from what was a 10+ year bull run for everything, essentially. Not the subprime crisis of 2009, but the coronavirus this time around. But essentially, governments dealing with it the same way, markets dealing with it the same way. So what have we seen in the last 2 weeks? We've seen kind of forced selling or indiscriminate selling of anything with any kind of liquidity. We've seen hedge funds being forced to delever. We've seen Fed rates drop to zero. We've seen communication about an unlimited amount of quantitative easing. We've seen the spread on actual physical gold versus future contracts blow out. Some really unprecedented type language and commentary from the London Bullion Exchange yesterday on supporting the COMEX. So every day, seemingly, another massive shoe dropping that ultimately, the last 2 weeks, people were selling everything they could. The primary focus was on getting liquidity, and that affected gold equities, certainly, like others, not as much, frankly, but it has. But ultimately, we think all this wrapped together is incredibly positive for the gold price and hence gold equities. Much like it was after the global financial crisis. So that's my view on what it means for gold. What does it mean specifically for us? Excuse me a second. And I'll obviously refer you to the forward-looking statement, but move to slide 3. Again, hopefully everyone's seeing this. Again, so what does it mean for us? Just by way of background, it's not on the slide, but for all of you, Cisco Royalties currently roughly a US $1.3 billion market cap company. We're traded on the New York Stock Exchange and the TSX. I think what we offer in this market is, or our business model rather, lends itself to these volatile markets. We are a royalty and streaming company, not an operating company. We have 135 royalty and streams, 16 of them operating, so cash flowing assets with different operators. So stability, I think, is the first thing I would say. Diversification in terms of the number of assets, where our cash flow comes from. It's not one individual mine. We don't have the cost creep or the cost pressure that others do in kind of an operating setting. We are largely in the Americas and largely in Canada with 80 or 85% of our asset value. We offer exposure to the gold price. So last year we produced 78,000 ounces, just over 78,000 ounces of gold equivalent. That's the acronym there, GEOs, gold equivalent ounces, at 90% margins, so cash margins. So hence, most of our assets are either NSRs. We do have some streams where we have a transfer price, but that's why our margins are what you see there. And last year we had record operating cash flow, 92 million dollars Canadian. That was at an average gold price. I think it was still shy of $1,400 for the year US. We have the highest dividend in our peer group. It's crept up as our share prices kind of decline, but at roughly 2%, the highest in our peer group. We have strong cash on the balance sheet, $108 million at the end of last year. We have a significant amount of investments that are going up and down, but still sizable to us, and plenty of capacity to do transactions or grow the company if we find the right opportunities. Add to that, and I'll show you a slide, a chart of this later on, but an incredibly cheap entry point. We're currently trading at roughly 0.8 times NAV, a significant discount to our peer group of royalty companies, and frankly, even at a discount to where the operating companies or many of the operating companies are trading, and that's without the asset risk, the operating risk. This is on slide 4, just a depiction of the Lassonde mining curve or Ed Goodman mining curve, depending on who you ascribe to. And I'll use this slide to talk a little bit about our business model. So we are a hybrid company. We do a couple of things that maybe some of the other royalty companies do not. We think that's for the good of our shareholders and ultimately gives us a business model that works across all parts of the cycle or whatever part of the cycle you're in. So on the front end, up this exploration curve, if you will, on the discovery side of things, we have a number of what we call accelerator companies, and I'll highlight again them to you on a different page, where we get involved in other exploration companies, provide money early on to get those companies started, to help them bring in assets, take royalties at that stage where they cost us maybe $5 or $10 million, so cheap, and ultimately get value through the equities that we own, and also by them delivering ounces, defining ounces, and ultimately making discoveries. That's worked incredibly well for us. The bets that we made in that regard, the $5 or $10 million that we invested several years ago, have turned into $50 to $100 million type assets for us as NSRs, as royalties. The bets we've made in that regard in the last more recently, we think will turn into significant assets for as well. So for those are things where we use our technical expertise, the people we have in house, again, which is a differentiating factor for us versus some of our peers, to find the right stories early, tack on the right people, add some financing, which we bring to the table, and have them kind of go off their way. In the middle of this slide, we continue to finance other entities, much like our peer group would. That would be helping financing construction for a development company or expansion capital for an existing producer, helping others to delever their balance sheets, so providing the typical business of royalty and streaming companies. That's our core business as well. And then more recently, at the bottom of this curve, essentially, we bought a company called Barkerville Gold Mines, which is a development asset in South Central British Columbia in Canada. That's a company we owned already a third of, one of our accelerator companies, essentially, that was moving through the trough, was about to go into development and feasibility and all those types of events that eventually lead to a construction decision. And our view is we would do that in-house, essentially, would bring that in-house, move it up the value chain, move it through the trough, permit, feasibility, grow it in ounces, and do that essentially with other people's money. So the intent there is we will be pushing that asset into a private vehicle funded by others largely, but our shareholders will end up with exposure to moving that asset through the curve and then coming out the other side with hopefully a much more valuable asset. On slide 5, it's just a summary of some of the things we did in 2019. We were quite active in the royalty space. You'll notice a bunch of these. I won't touch on all of them. Some of these were earlier stage things, like I mentioned, the Minera Alamos transaction. We bought an NSR on their project. Same with the Cisco Metals, which is one of our accelerator companies, Braylorn, all that in Q4. I already referenced the Barkerville transaction in Q4, but essentially quite active on that front, and we'll continue to be. We don't get full value for these, obviously, until they're in production, but this is money well spent in our minds, and we're quite happy with the portfolio that we already have. On slide 7, this is the trading multiple I referred to earlier. So the peer group significantly higher, and these are current prices. So this peer group typically tends to be 2 times NAV, with Franco-Nevada typically at a premium even to that. You know, they can range from 2.5 to 3 times NAV at times, but certainly in the order of 2. We're sitting today at 0.8 times NAV, and you know, I'll touch on that a little bit as well. We've already talked about our geographical mix relative to, or at least we talked about our geographical mix, but there on the right-hand side, you see it in relation to our peer group. So we're quite happy being largely Canadian-centric and North American-centric. We think that's the right place to take risk for our shareholders. You know, this multiple, we did get affected significantly. Our share price did in the fall of last year off the back of a couple assets that underperformed in our portfolio, and then specifically the Barkerville transaction that the sector did, or sorry, the investor base didn't exactly understand, and maybe we didn't do a particularly good job of explaining. But I think I've described the value arb that we saw there, and we're in the process of working hard to raise that external capital and as I said, use other people's money to move it up the value chain and retain a smaller interest for our shareholders, but ultimately an interest that we think will be more valuable. So that took off a big chunk of our market cap. I think it's now better understood, and we'll work to finish that transaction, basically close the loop there. I think when we do, we should get the benefit of that. It's a significant asset. I mean, we lost $600 million of value on the day we announced it, but it's circa 5 million ounces in Canada in one deposit that we think has the potential to grow significantly. Those assets have value in any market, and especially this type of market, and I'll touch base on that again. Slide 7, you just have you know, the graphical description of our asset base or parts of it. As I mentioned, largely America's focused, which I think bodes well for us, as geopolitical risk just in general is always high, and everywhere you look seems to be growing rather than shrinking. As well, in terms of an institutional perspective, you know, ESG is becoming an increasingly big topic. There's a lot of money that just can't be deployed into certain parts of the world. So as the investable universe shrinks from that perspective, we quite like having our assets in Canada and the United States. On slide 8, you've got kind of the growth histogram of our production since inception in 2014, where there was 7 assets, only one of which was cash flowing. The team has worked quite hard to grow it into a significant royalty company, the 4th largest in the world now. Last year producing 78,000 ounces, as I mentioned, at that 90% margin. A little dip from the year before, but really that was just because one of our assets had a contractual right to get bought back, and the operator had a period in time where they could do so, and they chose to, which we made money on. But we're back at growth. In 2020, we did have guidance of 82 to 88,000 ounces, again at the same 90% cash margin. We withdrew that just a couple of days ago, obviously virtue of what's happening with coronavirus. Some mines are getting temporarily shut down. We don't exactly know what's happening one day to the next, so we just thought it was prudent to come back to the market once things have died down a little bit. I touched on Malartic a little bit earlier. For those who don't know it, it's our cornerstone asset. We've got a 5% NSR in the largest gold mine in Canada. It was built by this team, by the Osisko team. They discovered it, delineated it, and built it. Ultimately sold through the hostile transaction that I mentioned earlier to Yamana and Agnico, 50-50, and our 5% NSR was pulled out. You notice the production there. So significant royalty, maybe the best in the royalty business, frankly, and our flagship asset. They are, as of I guess today, ramping down for the next couple weeks. But I will say, you know, again, none of us know where things are headed day to day. But this mine is a large open pit mine in Val-d'Or. It lends itself, if anything does, I think it lends itself quite well to self-isolation. Obviously, there's a decree by the Quebec government, so everything had to shut down. Otherwise, I don't know, frankly, if it would have. You know, you can sleep in your own bed at night. You can drive to work. You know, you drive a big yellow truck where you're isolated in the cabin, or a loader, or what have you. You can eat lunch in that truck. You can eat lunch in the parking lot in your own truck. And so you can avoid physical contact with a pretty spread out infrastructure. So again, I'm speculating here, but and that's more of a high level comment, but it's a mine that's very important to both operators, and one that lends itself to self-isolation. Hopefully, you know, what we're dealing with is very temporary in nature, but ultimately this is something that we don't think will impact this mine maybe as much as some others. On slide 10, the other point I'll make about Canadian Malartic, you know, right now it's benefiting from, you know, roughly, 650 to 700,000 ounces of annual production from an open pit, which should run deep into the rest of this decade. Below it, you'll start to see some of these colored blobs in purple and whatever that is, dark orange or brown. You know, they've delineated, the partners have, and again, the team at Osisko had punched the first few holes into Odyssey when the hostile came about in 2014. Didn't know then what it would turn into, but between Odyssey and a new discovery at East Goldie, which is much higher grade, you know, there's already 11.4 million ounces delineated underground, ounces that we have a 3 to 5% royalty on. You'll see the footnote there. It varies between deposits. Most importantly, on the higher grade East Goldie, we've got a 5% NSR. Now these would be underground ounces, but block or bulk tonnage type underground ounces, maybe not too dissimilar to what Agnico mines at Goldex next door. So a significant discovery underneath the most efficient mill in Canada, maybe one of the most efficient mills in the world, given the you know, the advantages of where it is and power rates, et cetera, the size and economies of scale. So this is something that's coming into focus kind of now. You know, the operators are working on it. They continue to drill it. They've said themselves it's open in all directions, including the higher grade East Goldie portion. So we don't know where this goes, but I think 2020 will be an important year for the operators to kind of describe what this asset is, what it means. But we're certainly quite enthusiastic about the fact that we may in fact have another flagship asset right underneath our existing flagship asset, which will take the mine life, if in production, way out into the future. Just touching base quickly on Eagle. This is Victoria Gold's project in the Yukon, Canada's newest gold mine. We have a 5% NSR on it as well, as the team helped along with Orion Mine Finance to finance that bill, and some lenders to finance that gold mine. Just ramping up over the course of this winter, which was a harsh winter in the Yukon, but I think they've done a quite good job. Despite that, there were supposed to be periods of the year, 3 months of the year, where they weren't doing all that much from an operating perspective. They managed to fight through that and get quite a bit accomplished. So it's a heap leach. It will take time to get to steady state. It will go through its normal, like any mine, its normal ramp up issues. You break something, you fix it, but largely ahead of schedule and pushing along, and we commend that team for the work they've done there. That's our newest growth asset in 2020. If you look at slide 12, sorry, mindful of the time. Look at slide 12, just some of our other assets. The point I would make here is we have a very deep organic growth profile. We don't really have to do too much. We've done a number of things over the last several years to build up this growth profile. So this is growth that by and large is already paid for by shareholders, and it's now starting to, some of these assets were earlier stage a couple of years ago, but they're maturing and they're kind of coming into their own. I mentioned Windfall, which we have a 2 or 3% NSR over by our sister company, Cisco Mining in Quebec. They've delineated a north of 5 million ounce deposit and are pushing it through kind of the study phases and ultimately development. So we're quite happy with the growth profile we have organically, and obviously, as any royalty company, will continue to look for assets externally to grow as well. Maybe on that point, we spent a lot of the last 2 years saying, that royalty and streaming deals were getting more expensive than we would like. We were seeing fewer of them as debt was available, as equity markets were relatively conducive, at least to some. Whenever this shakes out, whatever we're going through, we do see a period of time, whether it's 3, 6, 9 months from here, where even with a gold price being, even with the gold price being healthy and maybe even quite a bit higher, that there will be people left out of that space, less debt available, gold development companies struggling, or development companies with a gold byproduct struggling to fund themselves or needing to deliver. And so we'll look to be opportunistic and try to get better transactions done as more of those opportunities open up. Slide 13 here just shows you kind of some of the camps that we have royalties on and exposure to. I think the point here I would make is, there's 10,000, I think it equates to 10,000 square miles of camps, and they are camps, they're not individual assets, where we have NSRs and meaningful NSRs. Again, if you try to look through what's going to happen over the next, the rest of 2020, you've got mine closures, hopefully they're temporary. You've got a bit more stress in the system. The first thing that tends to happen when that occurs is that exploration spending gets curtailed and geologists get fired. It's just the way it works. Because of the flow-through system in Canada that we benefit from, or that exploration in Canada benefits from, if there's only $1 to spend in exploration in the world, it will be spent in Canada. So no matter what's happening to the exploration space globally, there's always flow-through dollars in Canada to put towards good projects, and as such, we will continue to benefit from those dollars being spent on our assets, and hopefully continuing to deliver more and more ounces to our books. I mentioned some of our accelerator strategy earlier on this slide. On slide 14, you'll see a depiction of some of the names. Osisko Mining being the most advanced and the most successful to date. Obviously, they've come down hard as others have. They at times have had a market cap of upwards of $1 billion, and have been highly successful at the drill bit at their Windfall project. It's interesting. Maybe as I was listening to Doug Doug's intro there, I might offer a different way to play the exploration and junior space. Through our accelerator companies, we have exposure, both equity ownership and NSR exposure to some of the better names in the exploration space. We think, again, largely Canadian centric or in safe jurisdictions. We continue to provide technical assistance to some of those groups when they need it, or capital markets assistance to some of those groups. We've been there to finance them in good times and bad. So we don't tend to want to orphan those companies. So if you're looking for, exposure to that space without having to pick names, without that technical expertise, we think we offer that as well. So not only do we have kind of the stability and the production and the leverage to cash flow, we also provide exposure to discovery and frankly, we think some of these are the better M&A targets in the sector as well. I won't dwell on this, but just back to my earlier point about getting involved early and using our technical skill set, and maybe a follow-on point to what I just said. These are two scenarios where we got in early, bought an NSR and some equity in the Windfall project, which is Osisko Mining, as well as the Hermosa project, which was Arizona Mining, bought by South 32, and came in when the market as a whole was still unsure about these assets. In the case of Windfall, formed the company and helped put the asset into it, and basically took our assets, be they the shares or the NSRs, early, paid what were fair prices for them at the time. But lo and behold, we've been quite successful making money on both the equities and having the NSRs grow in value as well. So I won't stop there. I'll just, this presentation has been changed around a bit. I will just touch on Barkerville for a second. I'm in the appendix on slide 21 here. As I mentioned, this was the development asset that we acquired that took out $600 million of market cap, but is an asset that we like then, and we like more and more every single day. We owned 1/3 of the company at the time before we bought out the remainder. It was an accelerator company of the groups, so our technical team was involved in every bit of it. Essentially did 350,000 meters of due diligence drilling as a company, and circa just shy of 5 million ounces delineated down to a depth of 350 meters. Significant drilling below that down to a depth of 1,000. No reason to believe that the deposit doesn't continue to grow there. We just haven't, the team hadn't done enough drilling to put it on the books, and that's all in that green box. Ultimately, it's a 67-kilometer trend that we think repeats itself, or we know repeats itself. Whether other parts of it will be economic or not, drilling will tell, but there's certainly good indications that it is. And then we found a parallel trend to that, which has a lot of the same earmarks that we're excited about. So, if I put my old banker hat on for a second, there's not that many 5 million ounce deposits in good jurisdictions left in the world, and certainly not 5 million ounce deposits that can grow to be significantly bigger than that. In a world where a lot of the big companies have gotten bigger through mergers of equals and cash flowing transactions or transactions for cash flowing assets, as they do that, it's my view that small assets just don't matter to their portfolios anymore. And when you turn around and you start, looking at companies, that have grown to be significant in size, when they need to pick up another project, it's got to be, it can't be 2 or 3 million ounces that you might be able to stretch. You need to look for significant assets, and 5 million ounce deposits are highly scarce. And we think this is one that will ultimately, maybe we're wrong about right now from a market perspective, but we don't intend to be wrong about it for very long. So with that, I will pause and happy to open it up for questions.
Thank you, Sandeep. Great presentation. We're pleased to have Sean Roosen on the line with us as a panelist. Sean, as you know, is the chairman of the board of directors and also CEO and original founder of one of the original founders of Osisko. Sean, do you have a question today?
I don't know that I have a question, but I just had a compliment that, you know, outside of the U.S. dollar world, the gold is at all-time highs in many currency, including the Canadian dollar, Australian dollar, euros, and pound sterling, the highest since 1987. And you know, we've set the course with this company to really secure premium tier one assets, both on the development side and also within the royalty portfolio. So where I sit right now is, you know, we're well placed to take advantage of a market that we're in, and offers a bit of leverage to the upside for shareholders that have, you know, maybe thought that they'd missed the Franco run or some of the other things. There's quite a bit for us to go here, and I think that over the next 6 to 12 months, you know, we hope to see that re-rate come into the stock as we get through the piece here. But it's, you know, in 5 years we've accumulated a significant amount of real estate and drilled off and been involved in more than 50 million ounces of discoveries in total, mostly here in Canada. So it's not like we haven't been here and done this before. The last company we sold for 4.3 billion. We'd spent $1 billion to build it, and shareholders made $3 billion plus in returns on that. So we know what success looks like, and we think that we're perched on a pretty good opportunity as we mature the business plan and the portfolio in this market with the all-time highs in most gold prices.
Thank you, Sean. It's great to have you on the call. We'll go through Q&A, and maybe I'll circle back to you a little later if that's agreeable.
Awesome.
We're going to start with Al Sebastian. Al, do you have a question today for management?
Yes. Can you hear me?
We can hear you fine, Al.
Yeah, we can hear you, Al. How are you?
Good, Sandeep. How are you?
Good, thanks.
Can you just go through sort of your liquidity position, you know, lines of credit, cash, debt maturity profile, and, you know, your cost of your bank lines of credit?
Sure, happy to. And this is probably the right slide to do some of that on. I'll just move myself out of my own way. So look, we ended the year with, as you can see, 108 million in cash, investments of 277 million, but you know, put that aside, 108 million in cash. We have just a tick over 350 million Canadian in converts, most of that due at the end of 2022 with pretty strong hands. And a credit facility that we can grow to as much as $500 million. And we had a pretty de minimis amount on it. I think it's 20 million we would pulled on it in the past. So plenty of cash on the balance sheet, long-ended debt, and plenty of firepower. So our liquidity position is quite good.
Okay, just how many people work for the company again?
We've got a corporate office in Montreal that's got 20 people that are exclusively Cisco Royalties, and then 20 others that are kind of technical in nature who do work for Cisco Royalties, but also primarily do work for a lot of our sister companies and the accelerator companies I mentioned earlier.
Okay, good. Thank you.
No problem, Al.
Thank you so much, Al. We're going to turn to Andy Carruthers down in Dallas. Andy, question today.
Andy, if you're speaking, you might be on mute.
Capital raise for the company. And
sorry, what was the question?
Huh? Sorry.
Andy, we can hear you now, buddy. You're asking about capital raise.
Yeah, did you hear me?
No, we didn't. But now you asked about a capital raise for the company?
Right.
You're asking if there's an upcoming capital raise for the company, Andy?
Yeah. When was the last capital raise and what were the terms?
Thanks, Andy. Appreciate it.
The last capital raise would have been the larger convert I mentioned to you. So it's got 2.5 years to go thereabouts. So probably 2.5 years ago. Sean might have the exact answer, but it would have been that convertible debenture.
Sure, it was done in 2017. We made an acquisition of 1.15 billion, and we issued convertible at I believe it was $18 a share. The convert up 35 from the market at the time. But most recently we purchased shares back in summer of 2019. We bought 8% of the outstanding stock back from the market through a transaction with Orion Mine Finance in exchange for some of our equities that we had for $174 million. And since inception in 2014, between share buybacks and dividends, we've given shareholders 350 million Canadian back on a company in 5 years. It's only 5 years old. We paid dividends our first quarter of existence.
Thanks for answering that, Sean. Andy, I hope that helps you.
Yeah, it does.
Wonderful. We'll turn now to Chip Richardson. Chip, good to have you on the call with us.
Thank you. I really don't have any questions. A very good presentation, and the questions I was going to ask have been answered. Thanks.
Wonderful. Thanks for your attendance, Chip. We're going to turn to our friend Chuck Deeds in Kansas. Chuck? Actually, Chuck, can you hear us? Let's come back to Chuck and let's turn to Chris Mulcahy. I'm sorry. Chris, question today?
Am I heard?
We can hear you, Chris, definitely.
Great presentation, Sandeep. Just bought some stock recently. My question, I'm going to ask you in the form of an analogy. You've been a deer hunter for quite a while, deer being royalties and NSRs. But deer as you admitted in your presentation, they're getting harder to find. You're farming some deer, but you're not content to do that. You decided to go out moose hunting in terms of Barkerville. Can you reassure us that how about talking about the management of that? I think I recall Barkerville is a pretty deep and complex formation that could take a lot of time and money to produce, and maybe some surprises in there. Should you be moose hunting when you've been so successful at deer hunting?
Sandeep, maybe I'll just take a quick run at this one.
Yeah, go ahead.
So, in terms of Barkerville, it has actually shallow. It's between surface and 350 meters down, which is about 1,000 feet. And it's in a mountain range. So the adit just goes in the side of the mountain. So development is quite shallow and by ramp only. There's no shafts, no complex mining. And the current mine with the PA site that we put out in August on the project delineates about 1.5 miles to 2 miles of the strike length. And we were at 4.3 million ounces of resource, of which we put 2.3 million ounces in the mine plan in the shallow portion. We just assumed that, we weren't going to go any deeper than that in this phase. And it's got a relatively low capex of about $225 million US to get a 200,000 ounce a year mine into production. And it also has a significant amount of low risk in terms of an existing milling site called QR and a lot of capital that was already there. It's on a paved road. It's 45 kilometers from the town of Quesnel, which is a town of 25,000 people, and 1.5 hours from a regional center called Prince George, which is the big city in central British Columbia. Historically, it's already produced 4 million ounces across it. What we've done is come back in and looked at a very, sort of sober, easy to mine operation. It's all long hole mining, nothing special, no modern techniques required, just very traditional things. And the first ore body is 140 or about 600 feet from the portal. And we have a site there already that was the old mill site. So there's a lot of infrastructure, brownfield development that's already been de-risked. And we had run the mill in 2018. We produced about 23,000 ounces during a test mining phase, and we're hoping to do some more test mining while we're in the bigger permitting plan here in 2020. So we don't really see it as a complex mine. We look at it more like it's a Malartic style project. It's in a historic mining camp. It's in Canada. It's on infrastructure. Metallurgy is well known. We're getting 92% recoveries on traditional ore sorter flotation gravity circuits. We'll be making doré on site. We won't be sending any concentrates to smelters. And the mineralization is pretty simple. It's what we call vein corridors, which are sort of mini shear systems hosted in sandstone. Clearly, obviously, when you're working in it, and the mining method is very traditional. So we think we're going to be mining at about between the PEA study at $790 all-in sustaining cost per ounce, and we're going to be building a 200,000 ounce a year mine for about $225 million at the get-go, with the life of mine being 12 years already, and significant amount of delineation outside of that with easily convertible ounces as we continue to drill once we're up and running.
Will you contract mine it, or are you going to manage it yourself?
We'll use contractors, certainly on development. The mining is not particularly complicated. It's 4 mine trucks and long hole, so we'll contract out as much as we can. There's many mining contractors within the region. We currently have a CMAC on site, and they're running the development and the test mining cycles. So we have real costs and real time, and we're the costs that we have in our PEA study are pretty real. And if you look at the NPV at $1,500 gold right now, sits around $900 million. At $1,325, it's about $600 million, and you've only used half the resource that's been delineated on the near surface resource.
Have you got all the permits you need?
We're in the permitting cycle for the bigger mine now, so we expect to see that about an 18 to 24 month permitting cycle.
Thanks very much.
Christopher, thanks for being on the call. Your questions are great.
Sorry, David, maybe I'll just add a couple things.
Surely.
Sean's the right guy to talk you through the technical aspects and the strategy there. But Barkerville, I think it comes down to an asset that the team knew better than anyone else out there. It had some legacy issues, but they kind of cracked the code on it, as they have on other things in the past. So knew it better than anyone else, liked it better than anything else out there we saw, and ultimately the exercise there is a value unlocking exercise, whereby we're going to be doing it in North Spirit. There's external capital meant to come into North Spirit to help us do that, and so we think ultimately, if you look around, I mean, everything that's happened in the development space has been happening on the private equity side. Private equity or royalty or streaming companies are the only ones that have really been financing those entities and deriving the benefit from them. So at the end of the day, when we're done, the intent is to give our public shareholders of Cisco Royalties, exposure to a private equity type return on that piece of the portfolio. And I think the other thing that's worth pointing out, Chris, is I think what people don't realize is in the last 2 years, when royalties and streaming deals were scarce, everyone compromised a little bit. I mean, we compromised on, as I said, the asset that we already owned a third of and liked and knew better than anybody else. But if you look at our peers, they compromised by going into some exotic commodities for gold royalty companies, by going off into exotic jurisdictions, by overpaying for processes. Ultimately, if you win a process where there's a lot of qualified buyers, you ultimately paid more than anyone else was willing to pay for it. So we compromised on Barkerville, so to speak, but we're happy with maybe not in the short term on what it did to the share price, but we're happy with what we own. And whilst we might have gone moose hunting, Chris, at least we didn't go fishing like some of our peers have.
Thank you, Sandeep. We're going to turn to Dr. James Wood. Dr. Wood, do you have a question today for management? Scott, have we got Dr. Wood unmuted?
Give him 1 second. He's unmuted. Can you hear us, Dr. Wood? Otherwise, I do have his questions written down as well. We could circle back to them.
Okay, let's go back to him. Let's keep going here because we've got a big group, and I want to make sure we get to everyone's question. Let's turn to Heinz Thoma. Heinz, do you have a question today?
Yes, Sandeep, thanks for the presentation. What do you see as a catalyst for the next 6 to 9 months, other than going back to normal, a normal situation?
Yeah, no, it's a fair question. I'll answer it as if it was kind of 2 weeks ago, and leave the rest to the world to figure out. But look, the catalyst for us this year, obviously the big one that's in our control is Barkerville. So finishing that exercise, bringing in the capital to kind of remove the overhang on our balance sheet, if you will. That's important. That's something we're working on all the time, and making good progress. So that's key. I think the rest of our portfolio, some of the things that went wrong in 2019, they can kind of fix themselves. That's what happens in a portfolio where assets are being operated by other people. We think some of that can come right in 2020. Eagle is the mine that's coming on for us, which is new to our production profile. So that's obviously important. We'll have to go through its ramp up challenges, which are normal, but we're excited about having that part of the production profile. And then thereafter, as I mentioned, Malartic is still our biggest driver. Getting better visibility on what's happening at the 11 million ounce and growing underground resource will be, I think, important, and I think that will start to come into focus for us this year as well. I mean, today we're sitting in a situation where most analysts you ask, most analysts on Bay Street or that cover the mining sector, are starting to build in value for the two operators, for Agnico and Yamana, for that underground, and yet if you look across the board, we get zeros for it in our portfolio for the same mine. So maybe with one exception. So I think people are looking to understand what that mine will look like, what that project will look like, what the future of Malartic will be, and we obviously know a lot about it. The team built it. We have our views, but we're pretty excited about that starting to unfold for the market to understand as well.
Thank you so much.
No problem.
Thank you, Heinz. We're going to go to Lincoln Rathman. Lincoln, good to have you on the call.
Hello, thank you for the presentations. Fascinating. You have 135 assets, and I think you said that 16 of them are cash flowing. How many, so I have a valuation question, how many of the 135 assets will eventually become cash flowing to you? Half, three quarters, something like that? That's my first part. And if you look at Malartic alone, what is the net present value, would you estimate, of that asset in relation to the market cap of Osisko Royalties?
Sure, Lincoln. So good questions. I don't think I've been asked I've only been on the job for 3 months, but I don't think I've been asked the first question before. Look, yes, right now 16 of them are cash flowing. We've got others in the pipeline, as I mentioned. Sorry, forgive me. That will start to hit the production side, hopefully as well. If I can get to it. So more things in our portfolio will start to come into the production side. Sorry, is the one speaking that's not on mute.
Okay, well, there's paper in here.
Could everyone do me a favor, except for the person speaking, everyone needs to mute. Otherwise we get the background noise. I really appreciate it. Okay, back to you, Sandeep.
Yeah, so there are things that are kind of coming into their own in our portfolio. Ultimately, how many of those 135 will, I don't know. I hope all eventually, but I may not be the president of the company when that happens. But certainly, we've got a pretty deep portfolio of near, medium-term, and longer-term assets that will derive value from. In terms of Malartic, obviously it's a big asset for us. It depends. If you just look at street consensus numbers, that can have an NPV of anywhere from 3 to 350 to $400 million just for the open pit. If you look at the underground and believe that becomes a mine, that arguably can double it. So no, it's important. Hopefully that answers your question, Lincoln.
Just if we assume that the underground deposit at Malartic is 10 million ounces, that would be 500,000 ounces net to us. In today's money, that's somewhere in the neighborhood of of $1 billion Canadian of value that's in that asset, or about 750,000 US dollars, $750 million US dollars to come in just on NPV from that one asset once the project is built. And in terms of growth in our portfolio, as Sandeep said, we've got probably 10,000 ounces a year coming in from Eagle at the Victoria mine there, and then Barkerville would represent a similar sort of 10,000 ounces a year in phase one. So we've got quite a bit of growth coming in things that we actually know are in motion.
Thanks for your question, Lincoln. We'll turn to Michael Potter. Michael, question today for management?
Yes, certainly. Thanks for a great talk, Sandeep. My question is, at Barkerville, what is your long-term end game? Is it actually to mine Barkerville, or to sell it off for a heap of cash and keep a 5% royalty?
Yeah, thanks, Michael, for the question. So look, with Barkerville, it's was and is a value exercise. We are a royalty and streaming company. That's our business. We haven't changed our minds about that. Obviously, the perception was that we swerved out of our lane, and fair enough, we're working hard to get back into our lane. But you have to think about it. These royalties, they only ultimately have value if they're producing. So our view was we could fast track that in a private vehicle and unlock more value for our shareholders in doing so. So the end game for now is first and foremost to raise money externally to advance the project. Excuse me. And do pretty ultimately cheap work that adds value over the next foreseeable future, the next year and a half, which is permitting, which is drilling to grow the ounces by leaps and bounds, we think, both at depth and, across that strike length, work on feasibility things. So low dollars, but high impact, and ultimately come out the other side with a ready to go project, which we think will be much bigger than it is on the books right now. At that point in time, North Spirit, the private group, which we will own a significant chunk of, can decide if there's been enough value that's been unlocked that the right thing to do is to monetize it at that point in time. If the view is collectively that there's more to do and more value to unlock by raising the capital to build it and to go through that construction period and then monetize it, that will be for that group to decide in the future. Obviously, we will be inherently involved as big owners of that asset, but the exercise is value driven. I don't know which way that will go, and we'll be nimble about what we do with it, but that's the end goal.
Thanks for your question, Michael. Another question?
Thanks a lot.
Okay, we'll turn to Steve Rentschler. Steve, question today?
Or Sandeep, if you could put on your investment banker hat again for a minute and just tell me, why is it that royalty companies you think should sell for like 2 times NAV or anything above NAV?
Well, look, I mean, I think we're back to a more steady state part of the world where even operating companies trade above NAV, and look, that is an issue that certain people have a problem with. Why should anything, frankly, trade above NAV if you've modeled it out correctly? I think the answer to that, there are a variety of answers to that. One of them, and the obvious one, is I think when analysts and these street consensus numbers we refer to 1 times, 2 times NAV, are modeling in today probably $1,400 long-term gold. And tend to be a little bit more conservative. Their numbers tend to be a bit stickier, and then the market, by where they price and how they value stocks, decide what they actually think the long-term or the commodity price is that should be running through those models and running through those companies. So I think that's a big part of it. But the point, and there's other reasons you can speculate about that premium in the gold space in particular. The point is, it's always been the case. I think it always will be the case. I think the market always prices in generally higher gold prices than the analysts do and whatnot. that royalty premium has also always existed, and that premium, I think, is easier to understand versus operating companies. You got safer, you got the same exposure to the commodity price, but safer top line revenue without all the cost creep and other capex creep that operator companies have to deal with, and in a diversified portfolio. So even a big mining company might have, some of the larger intermediates have 5, 6 mines. The biggest Barracks and Newmonts of the world, they might have dozens. But we sit here today as the 4th largest royalty company with 16 different producing assets. Some of them bigger than others, obviously. So we are pretty diversified in terms of our assets, the geographies, the operators. So it's a lot harder to ding our portfolio than it is your typical operating company.
Okay, and just the last question is, it's sort of 2 pieces. I remember listening to Barkerville a number of times as well, and it struck me that I think, they were talking about needing a couple $100 million worth of drilling and, doing the work to get the thing to a production decision. And I don't know how different your thoughts on, the whole thing are compared to what their management was, but how much of your current cash flow are you spending a year on the Barkerville? And also during this downdraft, have you been in the market buying your own stock back?
Sure. So look, on the first question, look, at the end of the day, things do cost money. Their team is now our team. They did spend considerably on exploration, but when you boil it all down, that their discovery cost was really good. I think their discovery cost was $25 an ounce all told, including everything, throwing everything into it. So they were highly successful and delineated, as I said, 4.5 million ounces and the upside beyond that. So we already have the ounces we need for the base project. I mean, the PEA that came out, that they put out, delineated a significant project, even at lower gold prices. So we have all we need to go through the permitting. Ultimately, we think there's a lot more ounces there. Do we need to delineate them all this year? No, we don't. We think there's enough meat on the bone that people that we talk to certainly see that there are more ounces there. So our spend is not what their spend was. Our spend right now is a little bit on drilling, some infill, some scout drilling, but the infill is to get to aid in a feasibility study ultimately. So it's a little bit of drilling that we think adds, incredible bang for our buck, and the rest is permitting. So it's paper exercises and obviously the cost of keeping a site functioning. So and clean up a little bit at the same time. So for us, it's low dollars that have big impact, and ultimately it's on our books right now at 100%, but the intent is not to keep it on our books for long. So these aren't big spends for a company our size. I think ultimately they're going to prove to be quite useful, and the intent, as I said, is to move them on to somebody else's book before too long. Your second question was about the NCIB. So look, I think when we started the year, our view was let's get out our message, and which we have and we continue to do all the time, and that's part of today. Maybe we'll be doing more of it this way in future, but let's get out our message. Let's tell people that we haven't changed stripes, and let's see where they end up. We have been active, and we're active with our NCIB. As our stock got ridiculously cheap in the last couple of weeks, but we're balancing that with obviously any day our mine is shut down, our key mine is shut down. We don't want to be spending dollars we're not making, but we're going to continue to balance cash preservation and protection and keeping money for growth projects, which we think are going to get more interesting and better value with supporting the stock as well.
Thanks very much for answering the questions.
No problem.
Thanks for being on the call, Steve. We'll turn to Vic Catan. Vic, questions today? Okay, Vic is listen only. Over to you, Scott. I think you had some questions from Dr. Wood, and then we'll proceed to close.
Yes, I do have some questions from him. Let me pull those up. And I also have some questions from the audience if there's time. Otherwise, we can get those answers to the individuals.
Yeah, we'll have to go back to them after the call. I think we've
Great.
got to.
So the first question is, during the coronavirus stock market panic, investors sold gold ETFs and gold stocks at low prices to cover margin calls. The Vanek GDX and GDXJ got hit hard by redemptions, causing Vanek to blow out stocks. Please explain why Osisko Gold Royalties got hit so hard despite gold only dropping modestly. How can you prevent similar adverse actions in the future?
Sure, and I think that was from Dr. Wood. Look, I'm not sure we can prevent, we certainly can't prevent this coronavirus or the next one or these types of external shocks. The truth is, when people need to sell and when they need to scramble to sell, like we saw 2 weeks ago and into last week as well, it's indiscriminate. It's your liquidity actually hurts you because people can actually sell your stock when they need to margin call. So that's not an Osisko specific issue. That's just the way it is. I think we've already started to see a bounce back. We're kind of back to levels we were at the start of 2 weeks ago. The gold price is held in. We're starting to see people on the institutional side with money to come back into the sector. I think they share some version of the view I started off by outlining on the gold side, on the future of the gold side, and that's very much what I hear. I think there are people waiting for something. That something is always a little bit different, no matter who you ask. Whether it's to start to see the bottom, wait for the next round of quarterly results, and see how painful they are. Wait to see deflation in the US dollar, whatever the case may be. Everyone's got a little something they're waiting for, but eventually there is money to deploy in those pockets and it will come back to the sector. And I think what we've seen time and time again is when it does, it all comes back at the same time. I mean, they all kind of move in a herd, and when that herd decides they want to come back in, it's pretty impressive what they can do to gold equities. So we think that's kind of what's in front of us, not just us, but the sector. We think our business model is a good one to hold in this way. We think the hybrid nature of it provides a lot of aspects that will be beneficial. So, again, to maybe to pick on something Doug said in that intro presentation, I forget exactly his you gotta have a train ticket, or you gotta be on the train, I think is what he said. So I think if you do have money to deploy to this sector, and you're trying to increase the gold exposure in your portfolio, obviously want to do your work, pick your spots. But I do think when it moves, it'll move quickly, and you probably want to be on the front end of that wave.
Thanks for that question. We've got one more from Dr. Wood.
Okay, so Dornoway Diamonds went into bankruptcy. Osisko was a major investor and royalty owner. How have you tried to mitigate and minimize that loss, and how long will the pain last?
Yeah, look, we've taken the beating on that one by and large. That was one of the instances I referred to that didn't work out in our portfolio last year. That's not a mine issue, really. That's a macro issue in the price of diamonds. That's a mine that was engineered or designed at $150 a carat, I believe, of diamond pricing. Was getting 70 into last year and started this year, and that's just a macro issue largely a macro issue on diamond prices. It's across the entire sector. So even with that, it's and I don't know too many gold projects or mines that can be designed and engineered at $1,400 gold and then still work at $7. So we kind of took the beating for that last year, took it through the credit bid process. Ultimately, our dollar exposure now is low, and we've got pretty good partners. So really just need to see that exercise through. Obviously, this coronavirus is not helping any of that, but ultimately we'd like to, when we did it, we had a 12 to 18 month time horizon or an 18-month time horizon. We're 6 months into it. And the macro environment would have to improve for us to get back to a world where our stream is valuable, and that's where we'd like to ultimately get to.
Thank you. Thanks. Good answer. Question, Scott. Do we have a question from John Hummel? He's in our audience and he's always one of our great.
I can call on him directly. I don't have a written in question.
That's okay. You could just call on to see if John before we proceed to close.
He is self-muted. John, can you hear us?
Okay, it's fine then. Okay, I think we turn it back to Sandeep and Sean if he has anything to say for closing remarks. We've had a very good Q&A here. Back to you, Sandeep.
Sure, thank you. Look, appreciate everyone's time on with us at the end of what was another wild trading day. So hopefully everyone stays safe and we come out of this as we will come out of this in a positive way. Hopefully there's not too many bumps and bruises along that way. And as I said, I think we're pretty comfortable with our business model. You know, these are tough markets to go through, but our business is better now than it was last year, obviously predicated on mines coming back into production. But our business is better now than it was last year, and it was a great business last year. So we'll focus on the things we can do. We'll be prudent, but opportunistic, and I think we got you know, from a business perspective at least, a exciting end of 2020. Sean, I don't know if you have anything to add, but
sure, I would just echo. I said, you know, gentlemen, I guess we come from a lot of us have been in this industry for a while. This is I've been here for 36 years, and one of my mentors always had a great saying: is that you never want to waste a good crisis. So let's take advantage of the situation. I think we have a pretty big arb on the value of gold and what's in this company. So I'll leave it to you guys to take advantage of the moment. And I hope your families keep safe, and hopefully everybody in the world can get through this piece. Thanks very much.
Thanks, Sean. Thank you, Sandeep. It was great to have you present today. Real pleasure. And I thank everyone for your attendance. Keep safe, and I wish you a pleasant evening. Take good care.